Hello, my name is Ray Bowman. I've been involved in international trade for over 30 years. I'm a certified global business professional. I'm also the director of the EDC Small Business Development Center, which is an SBA program that gives business assistance to small and medium-sized businesses throughout the country. I'm also the program chair of the Southern California District Export Council. We're a group of volunteers appointed by the U.S. Secretary of Commerce to promote U.S. exports. I'm also a professor at California Lutheran University, as well as Santa Barbara City College. Both institutions give classes and instruction on international trade, logistics, trade finance, and international business. I also belong to a number of trade organizations, including the American Association of Importers and Exporters, as well as NASBITE, which not only certifies the CGBP certification program, but also promotes small business international trade education. So in this lesson, I want to talk about landed cost. Landed cost is a real important topic for importers and exporters. So in import and export, the import price offered to that importer or buyer or the exporter can be based on all kinds of different things. So if you're an exporter, you may be quoting your price based on your price out of the factory, or you may have a price that includes getting the goods to the buyer at their home country. So landed cost is very important because landed cost gives us a benchmark to what our pricing should be to the ultimate consumer. So whether you're an importer or exporter, you should always think not only about the price that you're being offered, but the price that you're going to offer your client as well as the ultimate consumer. So landed cost is an important benchmark price to understand. Now in this lesson, we're going to focus on landed cost from the aspect of the unit cost. So the example that I'm going to give is based on one unit. So as we go through this example, imagine that this is one of several thousand units, say in an ocean container. So there's a big volume here. The reason I break it down per unit cost is when you're doing a price analysis, based on what a product cost in that foreign market, then it's really important to focus in on how all of these aspects of costs affect a single unit price. So that's why we're going through the example this way. We're also going to look at and review some of the aspects of some of the components of costs and focus in on some of the things that you need to know when you start to make a checklist of landed cost. We're also going to look at some calculations that are important to understand when you're calculating your landed cost. So let's go through the example, and we start our example with the factory. So the example that I have is an item where the factory cost is $6.38 with a markup of $1.12. And again, remember, this is one unit out of probably hundreds or thousands in a container. So that item starts out at a cost $6.38, but now we have a factory price of $7.50. We also think of this price as what we call an ex-works price, which is an Incoterm that describes the price offered from the seller from their factory. So next, we have to get the product to the port. So now we're looking at trucking fees. So with this item, we've assigned a trucker fee of 70 cents with a profit of 7 cents. So now our item that was $7.50 now is $8.20. So now the goods are being trucked to the port, and prior to them going to the port to export out, we're going to have certain broker-related costs associated with customs formalities and export fees. So these customs formalities charged out by a freight forwarder or customs broker, we've assigned at 50 cents per unit with a profit of 10 cents. So now our item goes up to $8.70. Next, we have freight and insurance. So freight and insurance can represent a substantial portion of a product's price. We've assigned an amount of $1.20 on this particular item with a profit of 6 cents. So now this single unit item that started out $7.50 is now $9.90. So freight fees represent the fees that the carrier is charging to get the goods to the foreign country, and insurance represents the cargo insurance, which protects if the goods are stolen, lost, or damaged. So now the goods arrive, let's say in the U.S. port, and for example, we're giving a 12% duty rate. So duty rates now, they can vary. There's thousands and thousands of duty rates. The U.S. Harmonized Code probably has upwards of 200,000 different classifications and many, many hundreds of different duty rates. So we've given an example of 12% duty, which wouldn't be uncommon for something like a garment. The customs duty will break out to about $1.19 on this particular item. So now this item has increased to $11.09. Once those goods are cleared by customs, they then go to the importer of record or the buyer. But let's say this buyer is an intermediary. Let's say this buyer is an importer. So this importer is eventually going to sell to a distributor who sells to a retailer. So in this situation, this importer is making a fairly small markup at 15%, which is $1.95 onto the price. So now they've added on to the price from customs, and now it's $13.04. Now this importer then sells to a distributor. So a distributor is basically selling to a geographical area meeting a certain demand. So this distributor is now going to mark up the item, and it's 22% markup. So now they're adding $3.67 to this item. So now the item that started out at the foreign factory at $7.50 is now at $16.71. So now finally, the distributor is going to feed the market demand and sell to the retailer. Retailers have to warehouse merchandise, get it into their stores, and then wait. And those items may be sitting on the shelves for a month or longer before they sell. So because of that, the retailer needs a fairly substantial markup. So in this case, it's 50%. That's not unusual for a markup. So now the retail profit is $16.71. So now this item that started out in the foreign factory at $7.50 is now $33.42. So huge markup. So now let's look at some of these components and sort of review them, going from the factory on in a little more detail. And again, when we're going through these different components, try to use this to make a checklist that will drive your pricing research so you can make your own landed cost. So at the factory, some of the costs that go into that price are the cost of goods plus the markup, but in addition to that, the packaging for export, right? So that could vary from putting the goods on a pallet, from having special packaging, special crates to put the merchandise in. It also includes the financing. So that factory, in order to make those goods, would have to access financing unless they're getting paid well in advance. And they also may have receivable insurance. So receivable insurance is a type of insurance that protects against non-payment by the part of the buyer. So many companies may take on that type of insurance to protect them, and that has to get rolled into the price. When the goods leave the factory, you have trucking costs, and this is the cost for the picking up of the goods. Now, the pickup or pre-carriage trucking costs depend on how far they are from the port. So it not only depends on the weight and size of the goods, but how far they are. So the further the factory is from the port, the higher the costs are going to be to transport them. Full containers throughout the world are flat rated for the most part. It represents a fairly inexpensive way to truck goods. But on the other hand, if you have air freight shipments or less than container loads, that can be charged by the pound or per kilo. So again, you have to look closely at how these rates are being charged and how the idea of weight and measure affects it. And again, weight and measure is the way a carrier charges, where they look at either the actual weight of the goods or the volume or the amount of space that they take up. So you want to be very conscious of that. Documentation can vary, and it's hard to pinpoint a number, but I'm just giving an example of, in this current market, of probably $75 or more to generate export documentation. Now again, the cost of documentation can vary according to how much work it is to produce the documents or multiple documents. So if you have certificates of origin, if you have export licenses, all of these things can add to the cost that a freight forwarder or other entity will charge to generate documentation. Custom formalities differ throughout the world. So the exporter, you have to check with the exporter, if you're not the direct exporter, to check on what those export formalities are and if there are any charges associated with that. Terminal fees, if applicable. So a lot of times the documentation in customs will include terminal fees as well. Freight and logistics. Air freight is charged per kilo throughout the world. Again, weight and measure, so either the actual weight of the goods or the volume, whichever is greater. So you have to be conscious of that to get an accurate costing when you're doing your landed cost. Ocean containers can be $1,000 and up to several $1,000s. Those ocean freight fees should also include things like terminal handling, bunker fees, destination fees, currency adjustment factors. So it's very important to check to make sure that the ocean freights you're being quoted include all of these ancillary fees. Again, international truck pricing is different based on miles or kilometers. So if you're not using air or ocean freight, you're doing, say, shipments from Canada to the U.S., U.S. to Mexico, then those fees are going to vary, but generally priced per mile or per kilometer. Import customs and brokerage fees. It's important to understand that customs charges fees based on value. There's all kinds of ways that customs can charge fees. Usually duty rates are based on percentages, but they could also be based on quantity or value. There can be compound duty rates, so it's important to understand that. Incoterms, as we've said in other videos, are three-letter codes that describe the responsibility between an international buyer and seller. Duty rates throughout the world can be based on different Incoterms. So in the U.S., import duty is based on FOB value, but in most other countries, it's CIF value, which means cost, insurance, and freight. Freight companies may charge for import paperwork processing. In other words, you may hire a freight company and they may charge a document processing fee to hand the documents to a customs broker for clearance. Usually, in most import transactions, the importer is the one that pays customs fees and coordinates import functions. And the importer can be the distributor, the retailer, all of the above. So it's important to check that. Distributors can be the direct importer or exporter. Remember, distributors have product liability because they're the ones purchasing product. There also may be warehouse and logistics costs associated with the distribution functions. The retailer has the highest markup, but again, they have the highest amount of risk as well. They often negotiate finance with the importer or distributor, so that's not unusual. So that landed cost price may also include the finance charges from those parties to extend terms to the retailer. You must forecast based on demand, pricing, and seasonality. And this is an important aspect of landed cost. What may constitute a high season or low season for your product may not necessarily coincide with high or low season on distribution, logistics, freight costs. So it's really important to understand that seasonality can be different between the supply chain costs and the actual cost of the product. And you have to adjust accordingly. So there's times where there's going to be high and low demand for your product, but at the same time there's high and low demand for freight charges. So now let's look at a couple critical calculations that you have to get familiar with in order to calculate an accurate landed cost. And the first one is a simple percentage. So whenever you're doing a landed cost, it's important to be able to calculate duties and taxes. Now there's different types of calculations depending upon how duty is assessed, but the most common is a simple duty calculation. So in other words, if the price to the importer was 100 and the duty rate was 25, then you would add $25 duty, right? So that's a fairly simple calculation. Most importers calculate that one fairly accurately. But now, here's where the trick comes. When you start calculating markup, that's different than calculating duty. The reason is, duty rates are based on an assessment against a selling price. Whereas when you're creating a markup, you're working from cost rather than a finished price. So a percentage markup, and this takes a little bit of practice, so if you're not familiar with this, it would be good to go back to this part of the video to look at the calculation and practice it a little. So let's say that the importer pays $100 and they want to put a profit of 25%. Well, this will require using a different proportion. So a simple calculation to calculate this is take 100% minus 25%, or 0.75, and divide the costs, $100, times the 0.75%, and you get 133.25. Now, think about it. That 133.25 is about an $8 difference than if you calculated, than if that $100 was a finished price and you were just putting a duty rate onto that. Now, how do we prove this? If you took that finished price of $133 and multiplied by 0.25, you would get the exact amount that you marked up that $100. So that's a way of checking your accuracy. Now, think about this for a minute. Let's say that you calculated the price as if it were a duty rate, your markup. You would be $8 off, and that doesn't sound like a huge margin for error, but the average international transaction can be $50,000 to $100,000. So let's say if you're dealing with $100,000, not $100,000, now you're losing $8,000. Over the course of a year, let's say you're doing $1 million. Now look at what the losses are. So it's very important to calculate these percentage markups accurately, because over a period of time, the losses can be greater and greater the more transactions that you're doing. So it's a very important calculation. Take a look at it closely and practice calculating it with different percentages. Now, the next calculation, which is equally important, is calculating your cost of money. Now, cost of money is important because most international transactions are open account terms. In other words, on open account, you're giving some time to pay as an exporter to your customer. So that customer is basically getting financing from you because you're extending terms. In other words, you're giving them terms which allow them not to have to borrow that amount of time from their bank. So if you're going to extend terms, In other words, take the role of a financer or lender to your customer, then you want to recover the amount of your finance cost back. So calculating per annum costs on a single transaction is a great exercise, and you should put that into your landed cost calculation. So here's an example of doing cost per annum. So let's say, so the formula for cost per annum is taking the amount of the transaction, taking whatever percentage that you're borrowing at, so whether it's bank financing or alternative financing, you take that annual percentage, you multiply by the amount of days that you think you're going to have to wait till you get paid, and you divide by the accounting standard of 360. So if we look at an example, let's take $100,000. Let's say we're borrowing from a bank at 8%, so we go 0.08. The average international transaction is 90 days. So let's use 90 days and now divide by 360. In this example, we have $2,000 of cost at 8%. So that's a substantial amount. We don't want to lose that $2,000. We want to build it into our price. So instead of offering $100,000 to our buyer who wants time to pay at 90 days, we build in $2,000 to recover our amount, or $102,000. Now, not all finance rates are bank financing. That tends to be the lowest type of financing we can access, but there is one other measure that can bring it down even more. And in previous tapes I've talked about, in previous videos I've talked about bill discounting. So let's say we're getting a rate as low as 2% on that same $100,000. When we run the calculation of 90 days, we get $500. So substantially lower rate to borrow. But again, we want to calculate that and roll that into our price so that we recover it, or at least realize how much we have to discount. It's not unusual for exporters to access alternative financing. Now, alternative financing is non-bank financing. So these are exporters who go to purchase order finance companies, letter of credit finance companies. The risk is much higher on this type of lending, and the terms are much shorter. They're very short-term borrowing strategies. So because of that, the per annum rate could be as high as 42%, right? If you're borrowing it at 5% or more per month, even though you're effectively not paying that whole per annum rate, it still works out to be that APR, or annual percentage rate. So at 42% on $100,000, we're already up to $10,000 in finance fees. Now, that isn't necessarily a bad thing. Let's say the only way we could have done this transaction is to do this type of financing, and there was enough profit built into the transaction that was worth doing even though we paid $10,000. Well, you still want to be able to work that $10,000 into your price. So it's very important to be able to calculate these things. Again, these percentage calculations, if they're not calculated correctly or forgotten, can really add up to large losses and throwing off your forecasts for your landed costs. So in summary, it's very important to realize that that in an international transaction, you have a lot more indirect costs, such as freight, logistics, warehousing, documentation, that go into your product price. So you have to be conscious of that. The other thing that's important to focus on too is that in import-export activity, there's a lot of things that go into to the final price that the consumer pays, and you have to be conscious of that when you're doing your price strategy or studying how much your item's going to sell for in a foreign market. Finally, it's very important, again, to focus on these percentage costs. If you don't calculate your markups correctly, per annum costs, freight costs, weight and measure costs, these are all different calculations, and they're simple calculations, but they have to go into your total landed cost. One final word about landed cost. These items of cost move around. Freight rates go up and down. If a shipment is going on ocean freight and all of a sudden you can't make that sailing and you have to do air freight, that's going to be substantially more. So all of these prices fluctuate. So what I always urge importers and exporters is to create a budget instead of a single landed cost. In other words, have a best case scenario, middle case, and worst case, and at least go for middle case. Have reasonable expectations of a range, a price range within all of the aspects of landed costs. So just don't keep yourself to the best possible scenario, but make sure you give a reasonable forecast based on a budget that ranges in price. If you do that, you'll be a lot more successful as an importer-exporter, and as a result, be more sustainable as a business. So I hope this video was helpful for you, and talk to you next time.